Well, stocks are under pressure and Treasury yields climbing as investors begin to succumb to the reality that Fed rate cuts may not come as early or as aggressive as they'd hoped. US retail sales this morning showing that the consumer remained strong to end 2023 despite slowdown concerns. We have Anthony Saccaro, Providence Financial and Insurance Services President, here to break all of this down. So, Anthony, how much of this is about the disconnect between Fed speak and market expectations versus just sort of a lot of people who sort of took those profits at the end of the year and just sort of clung on to the rally?
Well, the Federal Reserve has always said that it's going to be data dependent and they're going to make the changes along the way, depending on what the data says. And when Waller spoke yesterday, he basically, focused on the one thing that really has declined over time, which is GDP. That's come down. With everything else, when you talk about the labor market, when you talk about the strength of the consumer, when you talk about inflation spending, those were items that he talked about and then gave reasons why he thinks that they're going to slow down. He talked about the labor market and the fact that it's still strong, but the number of jobs per employee is coming down, so they expect that to weaken and to become more imbalanced. Consumer spending still up, right? December retail sales up 0.6%, but consumer savings are going down, credit card rates are going up, so they expect that that's going to go down over time. Inflation, is still higher than they want it to be on the PCE and both the CPI when you look at the year over year. But if you look at the last 3 months and 6 months, that's within a stone's throw distance of where they want it to be. So Waller did a compelling job of saying, hey, everything right now is in a great situation, but it's getting weaker. It's coming down, the metrics that we look at, and therefore we think that there are still going to be rate cuts. The challenge is, are they going to be as aggressive as the market is pricing in? And the Treasury yields are telling us that that's probably not going to happen. 60% chance in March that they cut the first time. I think it's what's being priced in. I have doubts about that.
Anthony, there is still the question about how much of that monetary policy has actually taken hold, right? I mean, that'll sort of determine the trajectory of the economy this year. We had some comments coming through from the IMF over in Davos yesterday saying 75% of the Fed's policy is now reflected in the U.S. economy. I wonder how you read that as you think about your investment case. How much further of a slowdown is there ahead?
Yeah, so Waller basically said yesterday that monetary policy is still tight, and that is very true. It is still tight. It's hard to quantify. Is it 75%? Is it 50%? Or is it 100% baked in? Right now, the numbers are going in the direction that we want. The CPI is coming down, the PCE is coming down, the labor market rate, if you look back at that a year ago, I think the ratio, there were 2 jobs available for every worker. And now there's only 1.5 jobs available. I think it's 1.4 jobs to be specific for every worker that's available. That number's come down. So the fact is that it's going in the right direction. And right now, the Federal Reserve has no reason to move at all. When March comes, if the data is still as strong as it is now, there's no reason for them to lower rates. There's going to have to be something that happens. Something's going to have to give in order for them to make a decision one way or the other.
And Nancy, some of the risks that we heard coming out of Davos, Jamie Dimon citing his concerns about US debt, about geopolitical risks, as well as some of the financial risks that he thinks markets have gotten complacent about. David Solomon also voicing that, especially when you think of still ongoing conflicts, 2 years in Ukraine, Israel, of course, and then what we're seeing in the Red Sea. At what point do we get a better vision and an understanding of how the risks are being priced in, and how can people position themselves?
Yeah, those are all great questions. I'm not even sure that they're necessarily answerable as far as when do we get a better understanding. I think we'll get a better understanding when something happens, right? We just don't know. That's the thing is with the geopolitical events, especially, I think that's the number one fear that I have is that something could happen. We can't put a terrorist attack on U.S. soil out of the realm of possibility. We've had it before. It's something that could happen again. We've got 2 wars going on at least. And then intellectual wars going on elsewhere geopolitically. I think that's the biggest risk. The challenge is how do you navigate that risk? And what we're doing with our clients, and keep in mind, I worked in the fixed income space with people who are retired. What I'm focused on is investments that pay income because the interest and dividends are something you can count on. And at this point in time, fixed income could be used as a capital appreciation play. That's something that hasn't happened or been available in over 4 decades. So I think whether you're retired and need the income, the high yield, it's a great time to lock in high yield, or if you're growing up and headed towards retirement, buying some fixed income for capital appreciation and locking in a high yield at the same time, I think all that makes sense.